If you have -$4 in your account right now, the bank already knows your name, your habits, and exactly how much money they can make off you. And if you have $25 million, they don't just know your name. They call you personally. Today I'm breaking down what banks actually do at every single net worth level, from broke to ultra rich, and once you see it, you'll never look at your bank the same way again. Banks don't treat everyone the same. That's not an opinion, that's their business model. The way a bank treats someone with -$4 is designed one way, and the way they treat someone with $25 million is designed a completely different way. Same building, same logo, two entirely different systems running underneath. And the wild part is, most people spend their entire lives inside the first system, never even knowing the second one exists. So let's go level by level, from the very bottom to the very top, and I'm going to show you exactly how the treatment changes, what triggers the shift, and what you can actually do to move yourself up that ladder faster. Now here's the truth. Wherever you are on this list right now, negative balance or your first 100,000, that position is not permanent. Banks bet on you staying exactly where you are. I'm here to make sure you don't. If this opened your eyes even a little, hit subscribe, because next I'm showing you the exact moves that push you from being treated like a transaction to being treated like a client they can't afford to lose. I'll see you in the next one. Let me ask you something. Have you ever been charged a fee for having too little money in your account? Sit with that for a second. Not for spending too much. Not for doing anything wrong. Just for being low on cash. If that's happened to you, you're not alone, and you're definitely not careless. You just experienced one of the most quietly profitable systems in all of banking. Here's how it works. When your balance dips below zero, or gets close to it, the bank doesn't see a person going through a rough patch. They see a transaction, a predictable one. Millions of people overdraft their accounts every single year, often by just a few dollars, and banks have built an entire fee structure around that predictability. A single overdraft can cost $30 or $35, sometimes more. Now imagine that happening 2 or 3 times in 1 month, because a coffee, a gas fill-up, and a subscription renewal all hit before payday. That's over $100 gone, not because someone overspent on something big, but because the system is built to charge for being short, not for being reckless. And here's the part that really gets people. It's not just about the fee itself. It's about what happens next. Once your account shows a pattern of low balances or frequent overdrafts, banks often start treating that account differently behind the scenes. You may notice fewer product offers, more automated responses, and almost no personal outreach. Meanwhile, someone with a healthy, stable balance might get offered a better card or a lower interest rate, just for existing. Same bank, same branch. Two completely different experiences, and the difference isn't intelligence or effort. It's simply the number sitting in the account. Think about it like this. Imagine 2 people walk into the same restaurant. One gets handed a menu with specials and a friendly greeting. The other gets seated near the kitchen and barely gets a second glance. Nothing was said out loud, but the treatment tells the story. That's essentially what's happening inside your banking app, just automated and invisible. Now, I want to be clear about something. This isn't about blaming anyone for where they are financially. Life happens. Paychecks land late, bills don't wait. What matters is understanding the system so it stops working against you by surprise. Once you know overdraft fees are a built-in revenue stream, not a random inconvenience, you can start watching for them, asking your bank about fee-free alternatives, or setting up low balance alerts so you see the dip before it becomes a charge. Because here's the real takeaway. The goal isn't to feel discouraged by where you're starting. It's to see the game clearly enough that you can start making moves that actually change your position over time. And that shift, from reacting to fees to understanding them, is usually the very first step toward climbing to the next level entirely. Quick question. Have you ever called your bank with a real question and ended up talking to a chatbot, then a recording, then finally a human who reads off a script and can't actually solve your problem? If that's happened to you, congratulations, you've just met what I call the invisible customer zone. And statistically, most people watching this right now live inside it. This is the range from $0 up to around $10,000. And here's the thing that surprises people. This isn't some tiny, rare category. This is the majority. Most account holders at most banks fall somewhere in this exact range, which means the systems built to serve this group aren't designed around personal attention. They're designed around volume. Millions of people moving through the exact same pipeline, getting the exact same responses. Let me paint the picture. Say you have around $3,000 sitting in checking and savings combined. You're not overdrafting. You're not struggling. You're just normal, steady, doing fine. But from the bank's perspective, you're also not especially profitable yet. So what do you get? You get the standard checking account, the default debit card, the automated fraud alerts, the same generic emails about budgeting tips that get sent to literally everyone else in this tier, regardless of what's actually going on in your financial life. It's not personal, and that's exactly the point. It was never designed to be personal. Here's a comparison that might make it click. Think of it like flying economy on a massive airline. You get where you're going, the service works, but nobody on that plane knows your name, remembers your preferences, or upgrades you without being asked. Meanwhile, a handful of passengers up front are getting checked on personally. Same flight, same airline, completely different experience, and the deciding factor was simply which section they were seated in. Now, does that mean this tier is a bad place to be? Not at all. Everyone starts here, and there's nothing wrong with being in the most common group of customers. But understanding this stage matters, because it explains something a lot of people misread as, the bank doesn't care about me specifically. It's not personal dismissal. It's structural design. Banks build automated systems for this range because it's the most efficient way to serve millions of people at once. The real value in understanding this tier is knowing what it takes to move out of it. It's rarely about one big dramatic change. It's usually about consistency, steady deposits, growing savings, fewer overdrafts. Small, repeated financial behaviors that quietly shift how a bank's internal systems categorize an account over time. And once that shift happens even slightly, the treatment on the other side starts to look completely different. Which is exactly where we're headed next. Here's something interesting. The moment your balance crosses a certain line, your mailbox and your inbox suddenly start looking a lot busier. More card offers, more loan pre-approvals, more exclusive invitations to upgrade your account. And no, that's not a coincidence. That's a system noticing you. Welcome to what I call the upsell zone, roughly $10,000 to $100,000. This is where something shifts. You're no longer just a number moving through an automated pipeline. You've become someone worth marketing to. But here's the important distinction, and this is the part most people miss. Worth marketing to is not the same as worth personally serving. There's a real difference between a bank wanting to sell you something and a bank wanting to build a relationship with you. Let's make this real. Say your combined balance crosses $30,000. Suddenly you start getting offers for a preferred checking account with a few extra perks, maybe a premium credit card with better rewards, maybe a personal loan offer that seems to appear right when your balance ticks up. None of this is random. Banks track balance trends, and once you cross certain thresholds, you get flagged into different marketing segments. You've essentially leveled up in their system, even if nobody ever tells you that directly. Here's a simple way to picture it. Imagine walking into a store you've shopped at a few times before. The staff doesn't know your name yet, but they've noticed you keep coming back and spending a little more each visit. So now they start showing you the newer arrivals, the slightly higher-end options, things they wouldn't necessarily walk over and show a first-time browser. That's not friendship. That's smart retail strategy. Banking works the same way. Now here's where people need to slow down and think carefully, because this stage carries real financial risk if it's misunderstood. Just because you're being offered a product doesn't mean that product is right for you. A credit line increase isn't free money. A new card with rewards isn't automatically a good deal if it comes with a high interest rate you might carry a balance on. This tier is designed to convert attention into revenue, so the smartest move here isn't to accept every offer that lands in your inbox. It's to evaluate each one on its own terms, compare it to what you actually need, and ask whether it truly fits your goals or simply fits the bank's. What makes this tier genuinely useful to understand is this: it's proof that your financial behavior is being noticed, tracked, and responded to. That's actually valuable information. It means the habits building your balance are working. And once that balance keeps climbing past this range, something even bigger changes. The bank doesn't just want to sell you products anymore. They start wanting to protect the relationship altogether. That's a completely different game, and it's exactly what we're getting into next. Here's a moment that changes everything, and most people never see it coming. One day, your bank calls you. Not an automated message, not a text reminding you about a payment. An actual person, with an actual name, who somehow already knows your account history before you've said a single word. If that's never happened to you, let me tell you exactly when it starts and why. This is the private banking threshold, somewhere around $100,000 up to $1 million. And this is where the entire relationship with your bank quietly flips. Up until this point, you were being marketed to. Now, you start being protected. That's not an accident, and it's not generosity either. It's strategy. At this level, banks realize something simple. A customer with this much sitting in accounts isn't just profitable through fees or products anymore. They're profitable simply by staying, so the bank's priority shifts from selling to retaining. Here's what that actually looks like in real life. Fees that used to apply to you before, monthly maintenance charges, minimum balance penalties, certain transfer fees, quietly start disappearing. Not because you ask, because the system now recognizes you as someone worth keeping happy rather than someone worth charging. You might also get assigned what's often called a relationship banker, or a dedicated point of contact. Someone who actually knows your name when you call, instead of routing you through the same general queue as everyone else. Think of it like being a regular at a small local restaurant, except this restaurant has thousands of locations. For years you sat wherever there was space. But once the owner personally recognizes you, things change. They seat you faster. They remember what you usually order. They comp small things here and there, not because they have to, but because keeping you coming back matters more to them than squeezing a few extra dollars out of your visit. That's essentially what's happening inside a bank once you cross this threshold. Now here's the part that really matters, and it's easy to miss if you're only thinking about lifestyle. This shift isn't about status or bragging rights. It's about access to better financial tools. At this level, you often gain access to higher yield savings options, more personalized guidance, and sometimes early conversations about long-term planning that simply aren't offered to accounts below this range. That's valuable. But it's also worth approaching carefully. More access means more decisions, and more decisions means it's worth taking time to understand any product before committing to it, rather than assuming personalized attention automatically means the best deal. What's fascinating is how quiet this transition is. There's no announcement, no badge, no official title change. One day you're just another account, and somewhere past that six-figure mark, you're suddenly a relationship worth protecting. And once that protection kicks in, the next shift is even bigger, because past this point, the bank stops thinking about your account and starts thinking about your entire financial future. Let me ask you this. At what point does a bank stop asking, "What can we sell this person?" and start asking, "What does this person actually need?" It's a bigger shift than most people realize, and it happens right around the $1 million mark. This is the wealth management level, roughly $1 million to $10 million. And here's what makes this tier genuinely different from everything before it. Up until now, every stage we've talked about was still fundamentally reactive. The bank waited for you to cross a line, then adjusted how they treated you. But at this level, the relationship becomes proactive. The bank isn't just responding to your balance anymore. They're actively involved in planning what happens to it next. Here's what that looks like in practice. Instead of one relationship banker, you often get access to an actual team. Someone focused on investment strategy, someone focused on tax efficiency, sometimes someone focused specifically on long-term planning, like preparing assets to pass on to family down the road. These aren't generic products pulled from a shelf. They're strategies built around your specific situation, your goals, your timeline, and your risk comfort. Let me put this in a picture that makes it click. Imagine the difference between buying a suit off the rack versus having one tailored specifically to your measurements. Both are suits. Both technically work. But one was made for anyone who happens to be your general size, and the other was built with only you in mind. That's the real difference between standard banking products and wealth management. It's not that one is better, in some flashy sense. It's that one is customized, and customization takes real time and expertise, which is exactly why it's typically reserved for this tier. Now, I want to be honest about something important here, because this is where a lot of content online gets misleading. Reaching this level doesn't mean guaranteed success or effortless wealth growth. Investment strategies still carry risk. Markets move up and down regardless of account size. What changes at this stage isn't a guarantee of better outcomes. It's access to more sophisticated planning and more personalized attention while navigating those outcomes. That distinction matters, and any honest conversation about this tier has to include it. What's genuinely interesting about this stage is the mindset shift it creates. At the earlier tiers, the relationship revolved around the bank finding ways to profit from you. At this tier, the bank profits by helping your wealth grow and stay protected over time because your continued success is now directly tied to theirs. That alignment is rare, and it only shows up once an account reaches a scale worth building an entire strategy around. And once that number keeps climbing past 10 million, something even more dramatic happens. The relationship stops looking like banking altogether and starts looking like something closer to a personal business partnership, which is exactly the level we're heading into next. Here's the final level, and it's the one most people will never personally experience, but it's fascinating to understand anyway. What happens when your money stops fitting inside a normal bank account altogether? This is the ultra-high net worth tier, $10 million to $25 million and beyond. And at this stage, the word customer almost stops applying. You're not really a client anymore in the traditional sense. You're closer to a business partner the bank is actively working to keep, because at this scale, the relationship works both ways. The bank isn't just serving this person, they're building around them. Here's what that actually looks like. Instead of calling a customer service line, there's often a dedicated private banker on direct contact, sometimes reachable outside normal business hours for time-sensitive matters. Instead of generic investment products, there's access to opportunities that never even get advertised publicly, sometimes called invite-only or private placement opportunities, things reserved specifically for accounts at this scale. Instead of standard planning conversations, there's often coordination across multiple specialists at once: investment strategists, tax specialists, estate planning experts, all working together as a single team built around one person's financial picture. Think of it like the difference between shopping at a regular store versus having someone come directly to you with options curated specifically around your taste, your history, and your goals, without you ever having to ask. That's the shift here. The bank isn't waiting for this person to come looking for solutions. They're proactively bringing solutions directly to them, because keeping this relationship intact matters immensely to the institution as a whole. Now here's something important to understand, especially since this tier can sound almost unreal from the outside. This level of access doesn't mean risk disappears, and it definitely doesn't mean outcomes are guaranteed. Larger sums of money still face market fluctuations, economic shifts, and real financial decisions that require careful thought. What's different here isn't certainty. It's the depth of planning, expertise, and personalized strategy available to help navigate that uncertainty. Scale changes the tools available. It doesn't change the fundamental rules of finance. What makes this final tier worth understanding, even if you never personally reach it, is what it reveals about the entire system we've walked through today. From negative balances all the way up to tens of millions, every single tier we covered has one thing in common. Treatment is never about who someone is as a person. It's about where they sit financially at that exact moment and how the institution calculates risk, opportunity, and value at that level. And that's actually the most useful insight in this whole video. Once you understand that banking treatment shifts based on financial position rather than personal identity, you stop taking it personally and you start seeing it clearly. That clarity alone puts you in a completely different position than most people watching this right now, because now you're not just reacting to the system. You understand exactly how it works. Here's what I need you to remember. Every single person at that $25 million level started somewhere on this exact list, most of them lower than you'd expect. Money doesn't ask where you started. It only responds to what you do next. So stop comparing your Chapter 1 to someone else's Chapter 20 and start making the moves that shift how the system sees you. Your net worth level today is not your identity. It's just your starting line. Let's go build from here.